Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
And we begin this hour with stocks rising as risk appetite returns after a stretch of volatility. Amy Wu Silverman of RBC Capital Markets writing, there's actually a lot more demand for hedging than is currently priced into the market. The risk of missing out is almost worse than the risk of a drawdown. And I'm pleased to say that Amy joins us now. And Amy, Matt and I were talking to you about a week ago in the midst of some of this downturn in the market. And you were talking about the shadow hedges, the desire for hedges, and the places people were turning to get them. How has that evolved over the past week as markets have recovered?
I think part of the problem that I had described was this idea that there is actually a lot of concern about the fragility of a lot of the trades because they're not only related to AI, they're related to the concentration risk that you see in the Mag 7. But obviously this year, it's been much more about that up crash being something that investors have to be concerned about, that fear of missing out. And so when you do get the down days, you get a little bit more pile on, and you do see that in the skew in the market, meaning that downside demand remains quite sticky. Even when you reverse the market moves and you have more up days, that skew hasn't quite changed as much, because again, that fragility is at top of investors' minds.
What about the treatment of tech, Amy? Because before it was a market that was pricing in all the AI winners would all be that they would all be winners. Things have started to change. We're looking at another day of NVIDIA losing in the pre-market and Alphabet gaining. Has the treatment of these stocks shifted? Has that narrative and the way we price it in started to move?
Yeah, and I think to some degree that actually might be a good thing. So one thing we look at isn't just inter-stock market dispersion, but obviously inter-Mag 7 dispersion. And so, on a day where you have NVIDIA going down, but Google going up, and obviously that story is tied to each other, then it becomes maybe something that's also more diversified, because one of the biggest concerns has been, if correlation rises because it's all one big trade, it's quite incestuous, that fragility is not good for the market, even in a time when things are going up. So if it is the case that one is more of a diversifier for the other, and you don't get that spike in correlation, I know for our investor base, when they're thinking about volatility and hedging, that is a big component in the market structure that is very key for how they diversify the portfolio.
Don't we necessarily have less correlation now among the Mag 7, right? They were all working together, investing in each other. It was a very incestuous, circular economy. And now you've got one against the other. It seems like it would reduce correlation and maybe even reduce concentration risk.
Yeah, exactly, Matt. So it's that diversifier aspect that is important. I mean, I think the thing is there's still that incestuousness hasn't fully gone away, and that's not just in terms of what CapEx investments are, but obviously there's issues on the credit side as well that investors are watching for. So I don't think, this alleviates the whole picture, but I actually think even though it's like Google is going up, NVIDIA is going down, the way that investors are thinking about it is, well, at least my implied correlation on the Mag 7 is something that could be a diversifier, so that this whole market isn't all reaching at once.
Amy, how strong does the retail bid look to you right now? Because we finally had a more than 5% drawdown, just barely, but it happened from peak to trough last week. Are retailers going to continue to be buying the dip? Is that still a huge presence in this market?
So it has waned, and you've seen that in some of the sentiment markers, Matt, but it is something that, we're watching very closely, because I think one thing we've talked about is the reason that institutional investors, just to be clear, have been afraid of, really piling in on hedges. That's why we call it shadow hedging, is that retail bid has continued to stay in the market. Now, there are these extraneous forces. So, for instance, how cryptocurrency is doing, how other factors are doing that are actually quite correlated to that retail bid. So we are watching those extraneous factors closely as well, because it is interesting to see when like crypto is always supposed to be this hedge asset, but in reality it is a risk asset. And then it's also very correlated to that bid that you see in NASDAQ. So I think those things, even though they're not directly tied into the stock market, are very important as factors for sentiment.
Amy, in terms of finding other places to hedge, there was a Goldman Sachs report about what hedge funds are shorting. And one of them that's at historic levels, albeit at a relatively low level, is utilities, 2.3% of free float. Again, that doesn't sound terribly exciting, but that is the most in history. I wonder if that could be interpreted as a hedge for AI, given the close proximity and the correlations we've been talking about. And if it is a hedge, does that make sense as one?
Yeah, I think it does. When you think about what everything comes down to and what could be the bottleneck for large parts of the AI trade, it's just getting enough compute, right? And that has implications not just for the United States, but if you think kind of bigger, it's also geopolitically the race that is going on right now between China and the United States. Again, it's that ability to do compute and what bottlenecks happen. The only issue I see when you think about doing it through utilities is one, there's just not that much market cap relative to other sectors, and two, that liquidity is traditionally not as, I guess, free flowing as other sectors. So if that you think about that as your hedge, I don't know if that is the cleanest that you could have versus outright owning something as a hedge in AI underliers.
Stay with us. More Bloomberg surveillance coming up after this.
Joining us now is Wendy Schiller, Director of the Taubman Institute for American Politics and Policy at Brown University. Wendy, these negotiations, as they're happening in the background, we're getting dear earnings that look really poor because of farmer suffering, consumer confidence that plunging, elections that affordability was at the forefront. How is this coloring the administration's approach as it talks to President Xi, as it negotiates with Europe in trade deals?
Hello, Donnie. I think that the president's got to balance his international clout in delivering for the domestic U.S. political market economically and politically. And he's getting so much pressure on all fronts. And it's now reflected in his poll numbers on the economy. Republicans typically have an advantage managing the economy. They still have an advantage over the Democrats on managing the economy. But the poll numbers for President Trump's managing of the economy have flipped. They were more confident. Now he's underwater. In particular, there's also some dynamics of the midterms in 26. Iowa, for example, big farm state, relies on exports. They have a Senate race. And that Senate race looked, maybe Iowa's gone red, but now it looks like Iowa, the winds are changing a little bit there. They've got a strong contender on the Democratic side, and we'll see who emerges on the Republican side. And that's something that's concerning the Senate. John Thune, in particular, has really been in the president's ear on agriculture, exports, and China. And an understanding that this doesn't just affect President Trump now, it could affect the standing of the Republicans in the Senate in 26.
Yeah, for sure. I mean, we see that farmers don't have enough money to order more John Deere equipment. They lowered their profit forecasts for next year. We have seen already automakers that have had to put production on hold because they're not getting enough rare earths. And then President Trump has this call with Xi in which the Chinese call out Taiwan as a major sticking point. It's not even in the U.S. president's readout, making it look like we're downplaying the important Taiwan issue in order to appease the Chinese. Are we losing this trade war?
Well, Matt, I mean, at the moment, the American people, as evidenced by a number of different polls across different polling companies that sort of tilt one way or the other politically, that the American public thinks we are, that the tariffs are now being blamed for affordability, high prices, layoffs. And this is something I think the Trump administration did not anticipate when he forged this sort of mantra that he was going to stick up for America, get a better deal, negotiate a better deal, and bring manufacturing home.
But every economist with a pulse warned the president about this.
Well, Donald Trump marches to his own tune, his own drummer, and he will emerge claiming credit for deals. China did agree to buy more soybeans about a month ago after John Thune pleaded with the president on this, but it still looks like we're going to have to pay out subsidies to the farmers from the U.S. Treasury to make up for these losses. And the president pivots, as we know, all the time. The question is, how will the Republicans in Congress treat this going into the midterms in 26? Because American public is starting to blame the Republican Party, and that's bad for them. So how effective are they in persuading Donald Trump to maybe renegotiate deals? But right now, it looks like China's still driving the bus on this and affecting, because of our geopolitics in the United States, how we elect people, which states are important. They understand that in China. They understand which markets are where and how that affects our politics. And 26 looms really large.
Is the president too focused on international relations when, we need someone to deal with the problem of skyrocketing health costs here? Apparently, they're going to lay out another 2-year extension to these really inefficient ACA subsidies, which the Republicans really wanted to avoid. But now it looks like we're just going to keep, paying these bills.
Well, Matt, every president does this. When things are going a little bit south domestically, every president turns the page towards foreign relations. It's not a partisan thing. It's not a Trump thing. But this is what I'm watching. I'm watching, will the Republicans, particularly in the House, come with the president? He clearly wants to sign an extension of these tax subsidies. He doesn't want to have millions of people who can't afford health insurance on his watch next year. That's what he wants to avoid. But the House is making noises that they don't want to do it, that they are uncomfortable doing it. Does he still have the same sway with the House GOP that he has appeared to have all year long? That's what I'm watching over the next couple of weeks and into January.
Stay with us. More Bloomberg surveillance coming up after this.
Barbara Doran of BD8 Capital Partners writing, for now, the AI play is still the place to be. Avoid small caps, staples, stick to quality, large caps, secular growers over cyclical. And Barbara, I'm pleased to say, joins us now. Really wonderful to see you this morning.
Nice to see you, Danny.
I'm interested by the fact you're not looking at cyclicals right now or small caps, especially since there's this hope that we're going to get Fed cuts. Maybe you add in fiscal stimulus and there's this reignition. Why are you still ignoring those sectors?
Well, I think the Fed cut, we may have one more now, but the economy has been doing fine, without aggressive Fed cuts, although we've had about, 1.5 percentage points in the last 14 months. But we've seen a number of false starts in terms of cyclicals and the small caps. And I see the small caps really as a trade because even with rates coming down a little bit, you still have 40% of the Russell 2000 don't make money. They have much higher cost of capital than return on investment typically. And unless rates come down significantly on the long end, I don't see them being helped. So I see that that's continuing as a trade. And in cyclicals, I think you have to be very selective. In industrials, for instance, you want to be, I think, doing industrials that are play on the AI build out in infrastructure, automation, robotics, that sort of thing. But it's hard to see a big reignition here of the economy. I think we're in for good growth, decent growth, and certainly we've seen that with the forward earnings guidance from the companies who just reported a great quarter. And certainly you do have the big, beautiful tax bill, the incentives coming there for CapEx and also bank deregulation, which should free up more capital to lend and spend. So next year is setting up nicely.
I'm kind of confused why that's kind of like a muddling along versus a growth reignition, because all of those do seem like powerful forces, Barbara.
Yeah, well, I think it is muddling along. You've seen this, this year, even with supposedly high interest rates that are, quote, restrictive, you've seen the economy do okay. And the earnings, we just had the 9th quarter in a row where earnings were up. And in fact, they were better than expected, some 13+% versus 8% expected. But it's still, we talked about AI, that is still the driver. If you look at what the Mag 7 did in earnings, ex-Meta, I take Meta out of the mix because they had a $16 billion one-time charge, right? But looking at that, the overall Mag 7 were up 30%, in aggregate earnings. And that's versus a 28+% for the last 4 quarters. So that's still the driver here.
I wonder about the massive CapEx plans that these companies have. You mentioned Meta, right? They want to spend, I think, $100 billion next year. Is that depreciation scary, as Michael Burry warns us about, the fact that they're going to buy all these chips, which may be worth, 20% less the moment they drive them off the lot?
Yeah, I mean, the depreciation, what I really keep my eye on is the demand, and if you're looking at very credible sources, see this market, data center infrastructure growing 5 times what it is now. So that really speaks to the demand that's out there. So, I mean, he's arguing about what are the real earnings, this and that, but to me, it's really what's the demand, what's the revenue potential, and that is very real. I mean, you just saw an acceleration there. I think that continues. We are still in the early stages of this AI rollout, so the concern about, we're in a bubble, there's too much money being spent, I don't think at all. You're going to see increasing usage of AI as it gets developed.
When do we get that revenue? Because I, started this job covering tech companies as Cisco was, the darling of the market, and we were spending as much as we could to lay fiber for the internet in the late 90s, early 2000s, and lo and behold, the revenue didn't come quickly enough. Cisco fell, and only now, like last week, have you made money on Cisco if you bought it in 1999 or 2000.
No, that's true. And I think so much, though, is about the timing, because some of the great tech companies of the past, you had great long runs and made a lot of money, but all things do come to an end. There's innovation, there's markets mature. I think the AI play, this is so big. And what we're seeing, I always mention Meta as the poster child, for what's happening in AI. They have been very early on applying it to their own business, and you've seen the results very quickly. They've increased their user base, the engagement is up, they've really increased improved their ad targeting, so they've improved more dollars, and you've got very early penetration. AI is still, and you heard it from Palo Alto last week, they talked about in their AI security, it's still scaling up because their customers, the big enterprises, are still figuring out how they're going to, what AI they need and how they're going to apply it. So this is going to be, you're going to see these increases in productivity over the next year or two. Exact timing, hard to know, but it will just increase. I mean, look at ChatGPT. I don't know about you all, but I use it all the time, and I increase my usage as I discover more things, and they have 600 million users a week. And so this is really still, and I talk to most of my friends, they're like, yeah, I should try it. There's still so much more to come, both consumer and enterprise.
It definitely feels like something we're waiting for, right? Like, when do the other companies benefit from productivity? I was looking at a Brookings study that was published recently where only 19% of their respondents said that AI increased their productivity. Only 4% said it significantly increased productivity. Robert, to your point, we're still trying to figure this out. So as you're looking for who benefits from AI, who can use it, where does productivity come from, is it just too early to say?
I think it is. I think we see different companies that are benefiting, but I think over the next 12 to 18 months, there's going to be some dramatic stories to be told about the improvements. And you look at, we're early on autonomous driving. We're early on the deployment of robotics. I mean, for instance, you've got Amazon, has 1 million robots out there. And so they're very early on that curve, but a lot of people are not. And so those are things that over the next year, and again, it's about competition. That's why you're seeing so much spending going into this, because people know I've got to do that. When you see people like Meta or Amazon who are already early users of all this and the productivity gains they are seeing as a company management, you go, we've got to do it too. And that requires spending up front.
Isn't there a chance, though, that they go too far with that spending, and at some point it no longer gets rewarded by the market? You're already starting to see that in some of the hyperscalers.
Right.
Does that continue on?
There's always that concern, and I think it's a legitimate concern, because at some point you can, and this is the thing in a capitalist economy, you don't have central planning, so everybody's rushing, to go after the profitability, typical margins come down. But I think where we are, the demand is so explosive, it's not a 6 or 9 month phenomenon. So at some point, that will be a factor. Right now, as far as the eye can see, you've just got this demand, this virtuous circle that will just keep going and going. But it is something you always have to watch. We know that the lifespan of industries, what happens, you attract players, they all want to make money, and eventually you can overbuild. I don't think it's like fiber, though. Fiber was much more limited. That was a very specific application and very prone to being overbuilt. This is just so much more complex. At the end of the day,
data centers are just like empty boxes. Those can't really be used for anything else besides data centers. At least on the infrastructure side, there's a chance we overbuild, no?
You could mine Bitcoin, I guess.
It's true. Great point, Matt.
Yeah, true.
But that is a place that it feels like we could go too far, and a lot of money has been put into that.
Yeah, no, it is. And because it is real estate in the end, what's going on there. But at the moment, again, everybody's watching that. It's like we're watching private credit, in terms of possible systemic risk. It's not there yet, and so you should still make a lot of money. And that's what we're going to continue to have these frights. Like, I remember the years when Amazon made no money and they kept reinvesting. And at least once a year, investors would throw up their hands and say, they will never make money. And they'd sell the stock off. Well, we now know how that story has ended. And I think we're going to continue to see these concerns with AI, and they're legitimate concerns. I just think it's way early.
Barbara, where do you, an investor who already has exposure to the mega cap hyperscalers, an investor who already has exposure to energy, where do you put new money?
Yeah, it's a problem because, in terms of, because you will have new companies starting, new applications and all that sort of thing. So a lot of people, you can look at the food chain, what goes into energy. Like you look at a company like GE Vernova, very expensive. They have great backlog, but they can only build so fast. So where do you put the money there? You can look at the suppliers and the components and all that sort of thing. But for now, it's not only the hyperscalers, it's the Broadcoms of the world. I mean, you saw what Broadcom did with the announcement that Alphabet, is going to be selling their TPUs, which are basically ASICs, custom chips to their customers. And so you still have a lot more to go there. And you're going to have these kinds of announcements, going on. And so that will change. Look at Alphabet. It has, outperformed. And just earlier this year, it was a laggard. They had the antitrust problems. People are like, oh, they're going to be left behind in the AI. And now look at it. It's like, oh, the darling, the star of the show.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.